Hey guys, lots of great information coming on today. Liam Wells from United Mortgage comes on, talks about credit and equity solutions. Tons of information, lots of good group content there. And also yours truly, I come on, talk about market conditions, specifically to the Eastern Pennsylvania area, and some issues that might arise with appraisals and how to tackle those. Again, great show. Thanks for tuning in. Hope you learned something.
By law, if you consensually give him your social security number when you're on the phone or through conversation, he is allowed to pull your credit.
If you're looking to purchase in a small or rural area, be aware of conflicting appraisals due to lack of data and inconsistencies in the information. Welcome to the Real Estate Investor Meetup. I'm your host, Matt Morrow. This is a place where knowledge is shared, friends collaborate, as we help each other to succeed in both our real estate and personal goals. We are a group of like-minded individuals from across the country who are here to help and support each other. Investors, realtors, entrepreneurs, and many others contribute to providing diverse and practical content for our events. Thanks for joining. We hope you enjoy the show and encourage you to bring others who may find value as we invest in our collective future.
Yep. Yes. All right, guys. How you guys doing this fine morning? My name is Liam Wells. I'm 20 years old. I go to college at Loyola in Baltimore in Maryland. I'm currently a sophomore. I study, I double major in finance economics. This past summer, I was able to get some great experience. I worked for a contractor. We renovated homes. We did bathrooms, kitchens. We did some really insane work. We did add-ons. It was cool. We did flooring. We did it all. And at that time, I was also studying for my brokerage license to become a mortgage loan officer, so I could sell some loans, get some experience in the real estate game. I did that in, I want to say, early August. So I've been working with United Mortgage Corporation for a couple months now. I just closed one of my first loans 2 weeks ago. And I'm here today to talk about credit for you guys. Hopefully I can add value to some of you guys, but this is one of the first times I've presented to a group like this. So wish me luck. Yeah, so I'm just going to go over the basics of credit. I'm sure you guys know, a lot about, credit scores and credit. I know some of you guys are pretty experienced investors. So I'm just going to start with the basics. Just bear with me. So your FICO score, there are two things that some people get confused about. It's your FICO and your credit score. Your FICO score is the combined score from TransUnion, Equifax, and Experian, which are the three main credit reporting agencies that we use as brokers that we look into when we're assessing somebody's ability to repay. The FICO score, it's usually a range between 300 to 850 on the higher end, and a higher score indicates better credit, obviously. But now there are different, if you look up FICO score, there are, in the most recent years, they've come out with all different sorts of, different FICO ratings, but the most common one is 300 to 850. And when you do get your credit pulled, it is the average of the three scores provided by TransUnion, Equifax, and Experian. It's the average of those three. Sorry about that. And here's a quick graphic of just like what's good, what's bad, what's excellent. Most people in the excellent category, I haven't seen many people in the excellent category. I've seen people in good and very good. And I've seen some people in poor. And let me tell you, if you are below fair, if your credit score is under a 580, you're not going to get a loan. I'm just even with an FHA, even if you go that route, even if you go, government backed, insured loan, if it's below 580, we really can't help you. But what affects your score? This is a big thing that people ask all the time. What are some of the biggest factors that, contribute to the score that we see? I think it's one of the biggest things is paying late. That really is a detriment to your score. That's 35% of your score is your payment history. Collections for bankruptcy and delinquent payments are not something you want on there. The next biggest thing is the amount of credit that you're using relative to your balance. So if you have a balance on your card, if your limit's $2,000 and you're using 1,700 of it, that's not good. They're looking for usually 50% or less. You want to be using 50% of or less of your available balance at any given time. It's not necessarily bad to use over 50% or go above and get to like that 80-90 range. But when you know that you're going to have your credit pulled, or if you're going to go to a lender or you're going to go to apply for another credit card, just make sure that you pay that down before they pull your credit. The age of your credit accounts is another thing that accounts for like 15% of the score. It refers to the age of your account. So, I mean, if you have a Lowe's credit card with like a balance of like $700 from a couple years ago, that's going to negatively affect your score, even though it's like a small amount. You should try to pay those accounts that are, small amounts from years ago off, because those do affect your accounts if you are, if you're on the minimal balance on those cards, it's not really beneficial to your credit. Recent applications to credit. So there is something called the 45-day rule, which I will get to later in the presentation. But when you actually apply for a mortgage or a credit card, and the lender or whoever, the agent is asking you, for your credit score, and they pull your credit, that does affect your score. Now, if you're only searching for mortgages and homes, you have a 45-day window where you can get as many lenders to pull your credit, and it doesn't affect your score only the first time they pull your credit. So that starts your 45-day window. And any time in between that 45 days, a lender goes to pull your credit, it doesn't affect it. It's only the first time. However, that's different than a credit card. If you have a mortgage guy come in and pull your credit, and then you immediately go to another credit card lender, that's going to be like a double hit on your credit, and that's 10% of your score. And that's called, when people pull your credit, it's called a hard inquiry. It can nick your score for up to 6 months. So that's definitely something you want to keep in mind. You don't want to just blatantly have, oh yeah, go ahead, pull my credit, go for it. You just, and applying for random credit cards, that's not something you really want to do. It does affect your score. But if you do it in moderation, I think you'll be just fine. If you have more than one type of credit, so like if you have a car loan, a mortgage, and a credit card, a Lowe's credit card, the variety of credit is all that's not necessarily a bad thing. The more variety you have, the more credit variety you have is actually better for your credit. If you do have a mortgage, a car loan, and a few credit cards, and you're able to pay them off, and you're not using above 50% of your available balance, you should be in the good to excellent range. You should have no problem with that. Now, why is it important to keep good credit? I think that's a no-brainer. Like I said, if you are in that good to excellent category, the doors are wide open for you. You're allowed to, save on a lower interest rate. You're allowed to, more lenders would want to lend to you because you're a credit-worthy borrower. So it's important. Not everybody has a pile of cash sitting around these days for large purchases. Like a home, a car, even student loans. Quite frankly, your credit score determines how much you're going to be paying for these items.
Hey, Liam, I have a question.
Yeah.
Hey, Liam, this is Richard. I have a question for you. What is your view on the credit scores received from places like Credit Karma or, you know, those organizations versus when you pull it as a mortgage broker? It always seemed to me like what you pull is lower than what one of those agencies might report.
Yeah. So that's a good question. I actually haven't been on like Credit Karma or all those. I haven't seen that. That's something I should look into and see like what the exact difference is. However, later in the presentation, I will go through. There is legally, you are allowed to look at your credit report annually. And I included that link in the PowerPoint and in my notes that Matt will make available to you at the end. But you're actually able to access your credit report from the 3 credit bureaus, and you can look at it and make sure there aren't any errors. And I go through that in a little bit. Mistakes for checking your credit report annually. There a lot. Sometimes these agencies get stuff wrong, and you'd be surprised actually how often that's stuff like that happens.
Okay.
Yeah, but I hope I don't know if that answered your question, but I would.
Yeah, it seems like there's, when you get anything online, their goal is probably to try and make you feel as good as possible or whatever. I don't know. But whenever a mortgage company pulls, or a bank even pulls credit reports and they show you your scores, and correct me if I'm wrong, but the scores actually are recalculated or changed daily. Is that right?
So that's another good question. The way that the agencies do that, how they do it exactly, is very secretive. For what reason, I don't know. Maybe it's I don't know why, but they're not very upfront. Even if you go to the CFPB, which is the Consumer Financial Protection Bureau, where all this information is, and stuff like that, they don't really give you a good explanation on how this stuff's calculated. I will say, when you go, your credit score is a snapshot of your credit report at the current moment. So like I said earlier, if you know that you have above 50%, you're using above 50% of your available credit, before you go to get your credit checked, pay that down. So it's like, 50, or even in some cases I've seen as low as like 10% of people are using 10%, 15% of their available balance, and that will get you the best score possible at that moment. So it's not like you've had 75%, you've used 75% of your available balance. They go to pull your credit, and they see that it's your credit at the current moment. Like, if I were to go get my credit pulled today, it would be what it is today, with all my cards, with all my balances today. Did that answer your question?
Yes, understood. Thank you. Thank you.
Liam, that brings up a really good point. There is nowhere that anyone can find the calculation for individual credit scores. The businesses, if you have a Dun & Bradstreet profile, you can kind of see how your business is evaluated based on performance. You have to upload profit and loss statements. But for personal calculation, that 750, just arbitrary number, there is nowhere that you can find how that's calculated, which is kind of concerning.
Well, it's been that way forever. I'm actually more interested in commercial credit than I am in personal credit, but I'm hoping you'll touch on that at least during the presentation.
I'm sorry. I was given a very broad stroke of credit. I would have included commercial credit if I would have known. I would have done some research on that. I can definitely I could definitely do that, and get some information out to you if that interests you, for sure. But yeah. But like I said, it's very important to keep your credit clean. It literally determines, what you're going to pay for items. Like I said, it's not to worry if it's bad at this point. You can always fix it, always clean it up. It's only a snapshot of your credit at this exact moment. But like we said, nobody really knows how this stuff is calculated. But mistakes when you are looking at your annual credit report that you are able to get once a year, definitely look for identity errors. You wouldn't imagine the amount of times I've seen from years ago when people have gotten their credit pulled, the lenders that they've went to years ago misspelled a name, misspelled an address, have done all types of crazy things, and they think, oh, there's red flags that go up because things don't match, and that does throw off your credit, unfortunately. So make sure that you are looking at identity errors to your personal information, wrong name, phone number, address, accounts belonging to another person with the same or similar name as yours. You don't want mixing of two consumers' information in a single file. When that happens, it's called a mixed file. You don't want that. Like if you have your wife's credit information with yours, it's not something you want. That brings down your score. And this information is directly from the CFPB. So if anybody's wondering, incorrect reporting account status, closed accounts, but they're reported as open. So if you closed a credit, you paid off a Lowe's credit card or a Kohl's credit card, and now they're still saying a balance on it, and you closed it, make sure you get that taken care of, and report that, and take the proper steps to clear that away, because that does negatively affect your score. Yeah, when you're reported as the owner of the account when you're actually just an authorized user, yeah, you don't want to be late or delinquent on any of these, even if they're incorrect. Make sure you check. Data management errors, like reinsertion of incorrect information after it was corrected. So like, for example, if you were to get this information from Kohl's that, your credit, you close your account, they said, yep, it's closed, blah, blah, blah. And then you see it's still on there. That's something happened. There was miscommunication between Kohl's and somewhere else. You got to make sure that that's under control. And, balance errors are another big thing. Make sure that if you paid something off, it's paid off. And if there's any errors on there, you got to fix them. That's it, plain and simple. Or else, that affects your credit, for sure, if there are errors. And you might not even be aware. So definitely check that out once a year. Make sure you're okay. Just some basic credit tips to improve your credit. I kind of went over them already, but like I said, make sure you're not delinquent on any payments. When you go, and I kind of touched on this earlier, when you go to the lender and you ask, I want to be pre-approved, he's going to ask you for your social security number. And by law, if you provide it to him, you are legally, you are consciously giving him consent to pull your credit. And now that's something that not a lot of people know. Oh yeah, no, my credit's not going to get affected because he didn't tell me it was. But if you legally, by law, if you consensually give him your social security number when you're on the phone or through conversation, he is allowed to pull your credit. He is allowed to, and get you that pre-approval. And then that opens that 45-day window where you can shop around and get as many credit pulls as you want without affecting your score. Yeah, so just be careful of that, I would say. I've heard a lot of people that they have fallen victim to that.
Liam, that's great information. I did not know that. That could be very valuable for people who are just applying for their first, especially younger people. That's really, really good. Thanks for sharing that. Yeah, for sure. It's crazy, it's upsetting, because not a lot of people know, and then they're like, why is my credit score go down 10 points? And then it's like, that's why. So yeah.
Liam, is there a time period, like if they pull your credit, you're applying for a mortgage, whatever, it drops your score 10 points, 20 points, is there a time period at which that sort of goes away and you come back to where you were, or is there long standing effects of that?
I've read 6 months. I've heard anywhere from 6 months. So,
I've heard a year.
yeah. So if you go and apply for a mortgage from a lender, right? And you say, I want my credit pulled, here's my social, and they do that, right? You have a 45-day window to go to any other lender in the area, wherever, and get your credit pulled without it affecting your score again. You know what I'm saying?
Uh-huh.
So yeah, so you can get your credit score pulled once from a lender, and then 45 days you can get it pulled as many times as you want by lenders, though. By lenders, and it won't affect your score. Only that one time will. That doesn't apply for credit cards, though. If you know, credit cards are a completely different thing. Those affect your score as well. Is that good? Did I answer your question?
Yeah, I think the question, Liam, is how long does that effect last? If it drops your score 10 points and you mentioned 6 months,
Yeah.
I've heard it was a year. In my case, just speaking personally, when I was rebuilding credit, I had a lot of inquiries, right? That's what they're called, right? And so after a period of time, there was one point where I had too many inquiries and was rejected, right?
Yep.
And then maybe like I waited like 6 months or a year later, and you know, I think the inquiries themselves drop off in a year, but the effect probably is remediated within 6 months. Does that sound about right to you?
That might be correct. I honestly would have to look into it to give you a definite answer. I'm not too sure. It might that sounds correct. That sounds probably about right.
I think in my case, there's been some times where I've had a pull on my credit, and I think it's been on there for almost 2 years. And as far as like the effects of your credit score, it's hard for me to say because, you know, I'm using my credit cards and I'm paying them off. So it's hard to really isolate whether it's going up and down based upon that particular inquiry or not, or it's just using my credit card. But I think the hard pull has been on there for almost like 2 years in some cases, I think.
That's interesting. Yeah, that is interesting.
Because I know I was specifically watching that at one point and thinking, okay, when's this going to drop off? When's this going to drop off? And it was quite a while.
Now, I will say this: I did make a request to the 3 bureaus to remove the inquiries, and they did it.
They did not.
Huh?
They did not.
No, they did.
Oh, okay. Cool.
Yeah, I petitioned the credit reporting agencies to remove inquiries on my credit report. I can't remember the reason why I gave or anything, but I asked them to remove the inquiries.
That's good to know.
They did. Yeah.
So some of that's counterintuitive, right? You could have an 800 whatever credit score and apply for a mortgage on a rental house. They pull your credit and go, it's great. Yeah, we'll give you a loan. Now let's drop your credit score because you had great credit, right? So it's a little weird the way they do things.
Yeah, it's strange. It's strange. They keep it kind of secretive for I don't know for what reason, but it's annoying. It's annoying for sure. So I'm gonna get into some types of like conventional loan requirements and like debt to income ratios and LTVs, because I didn't want to go into too much depth about like the different regulations for the different types of loans, like VA and USDA types of things. If you want that information, I can send some stuff out to you guys like on those loans specifically, but I only covered conventional loans and FHA loans because those are the most common.
Hey, Liam.
So oh, sorry, what's up?
For future, if you wouldn't mind, I know all of us would be highly interested in the commercial products as
Sure.
well as low down payment like FHA, either 203K style or owner occupied loans. I know Ryan and Rick right now are both looking for items of that sort. But the conventional stuff is really the baseline for everything, because that's where most of the loans are generated. But it would be a really, really good idea for those kinds of subjects to come up in the future, if you wouldn't mind, for
Sure.
another meetup, that'd be great.
Yeah, not at all. You said commercial, you said 203 case file.
Yeah, 203, the FHA 203K loans for the rehab.
Okay.
And maybe either any low down payment loan options that are out there, but I'll stop bugging you.
No worries. Yeah, I will definitely do that. I think those are good topics. I'm just writing that down. But yeah, so this is the link. I don't think it's I don't think it's active. You might just have to copy and paste it and put it into your browser. But if you go to this website, this is where you can get your free credit report once a year. This is the link for that. So you can get it once a year. I think it updates once a year. And this is where you'll be able to see your report, not your score, but your report. So, that's important. This is where you can make sure your information is correct. No delinquent payments. That's where you do it. So conventional loans, minimum credit score is 620 to 640. Now the max LTV, I'm sure you guys know what that is, but that's just loan to value. So, if you have a $100,000 property and you need $97,000 to pay for, you're going to put $3,000 down and use a loan of $97,000. That's pretty much what that means. Now, I've never seen that. I've pretty much seen 80% LTV. Now that I could be wrong. I'm sure there are cases where you are able to do that, but at least is what I've seen. I've seen 20% down. And that might be because if you don't put up to 20% down, you have to pay mortgage insurance. So that may be a reason why, and that's just an additional expense that is kind of useless in my opinion. It's just cuts in the profits if it is a rental property. So I think that is why most people put that down. And if you're below this, if you're below the 620, you cannot qualify for a conventional loan. You qualify for an FHA. That means you're entitled to higher interest rates, means you're paying more money, less profit. So it's important. I included the debt to income ratios. So this is kind of slander, like back end and front end. Front end just means your mortgage divided by your income, and it's mortgage payment only divided by income. And that can only be, your mortgage payment can be at the most 28% of your total income. So I don't know the math quickly.
They call that housing allowance.
Correct. And then the back end, 36% back end is all your other credit obligations. Now that doesn't mean your Netflix subscription or your T-Mobile bill is going to be included in this back end ratio, but it's all your other credit obligations, Kohl's credit card, student loans, anything that would show up on our credit report is included in the back end ratio.
Is the income pre-tax or after tax?
I believe it's pre-tax. Yeah, I believe it's pre-tax.
Okay, thanks.
That's a good question, though. I'm not sure
All right.
completely, but I believe it's pre-tax.
Okay.
I'm going to write that down. But yeah, so that's conventional. Those are conventional loans, and these are sold to investors. These aren't sold to government agencies. So FHA loan, the minimum is a 580 credit score. So if, like I know I mentioned this earlier, if you have anywhere below a 580 credit score, you're kind of SOL, unfortunately. Max LTV 96.5%, but like I said, I haven't really seen that. I've really seen 80% down, and even I think 80% LTV, you still have to pay mortgage insurance. It's once you reach 78% LTV, that's when the mortgage insurance is lifted. So once you reach 78% LTV, your mortgage insurance is lifted and you don't have to worry about that. So, I mean, that's 22% down if you are to purchase a rental property. It's, or I mean, or if you do put 20% down, and the next couple months, you'll be able to drop the mortgage insurance when you're paying, when the renter or tenant is paying equity into the home. So that's just something to know. Seller concessions are limited to 6%. So for these specific loans, so I mean, and that's to the loan, 6% of the loan value. If you're able to make an agreement with the seller and they really want to get out of the house, they're willing to pay some of your closing costs, it's only allowed to be 6% of the loan value. So something to keep in mind. And
question, Liam, that seller concessions of 6%, does that also gets calculated against your DTI, does it not? If he's carrying a second, I know for conventional, they count the all loan obligations or existing obligations and credit, plus if the seller is going to carry a note amortized, then that comes out as well.
That's not a note, is it, Richard? That's like the seller says, I'll sell this $100,000 house for you at 106 and I'll give you 6 back at closing.
Yeah, that's what
no.
Yep.
Yeah, no. I'm thinking of if you wanted to come up with some additional down payment by using the seller's money.
Yes.
I think that's different than a concession.
Yeah. So if you were
I guess
if you were to get some seller help for the down payment, the bank, if they're aware of said down payment, like Richard, you're talking about, if you were to get a $10,000 loan from the seller, if the bank was aware of that, that would likely be included in your.
That's correct.
Yeah.
If the bank's aware of it, that is included in to your obligations. That would be included in your back end ratio. Yes, that's correct. Right. If the bank's aware, though, if the bank's not aware,
that's an interesting point, right? I mean, you have to disclose all of your obligations, and when even before the CD is done, you're going to know about that second.
That's correct. Yeah. Yes. I mean, unless. I mean,
how are you not going to know about that if you're a lender, right?
I'm not sure. I mean, maybe if you made some sort of deal that was not on paper, and if you made some sort of deal, and I mean, that's a huge risk because you can't involve legalities into that issue if somebody were not.
Right.
So yeah, I mean, if you wanted to take on no risk, you would pretty much have to make it legal, and then at that point you can't hide it.
Okay.
Yeah, but that would be a back end calculation. So the upfront mortgage insurance premium is one for FHA loans is 1.75% of the total loan balance. So that's what you'd be paying as an additional. You would divide that by your loan term and then by your monthly rate or your monthly amount of payments. And that's how much you would be paying per month additional. Now, these are a little higher. They're a little more lenient because they are government backed. The government can just print more money if things, we're going to be testing that, in a couple months, but they are government backed. So they're more lenient with the ratios, 31% front end, 43% back end. And as you can tell, they're a little higher than the conventional loans. Let's see here. Yeah. So we kind of touched on this already, but as a lender, we look at people's ability to repay, the mortgage payment to the debt to income ratio, simple stuff. The way I remember it is MICE does mortgage payment, income, credit report, employment, debt to income, other debts, expenses, simultaneous mortgages or second mortgages. Like we said earlier, if you do have another obligation to a seller, like we spoke about in that scenario, then that would be included in their debt to income ratio. that would be calculated in there. Does anybody need clarification on these points?
I just have a quick question. When it says mortgage payment, that's strictly, and in the equation too, when it says mortgage, that's strictly just the mortgage payment, right? And not the taxes and insurance that come along with it.
Yep, it's just principal and interest.
Just principal and interest.
That's correct.
Okay.
Yes. Yep. So now we'll get into some products. I briefly just went over HELOCs. If anybody wants any more information about like the strict comparisons between, a HELOC and the cash out refinance, let me know. I can get that information out to you. The main difference is a HELOC is a revolving line of credit. A cash out refinance is you're getting a whole new mortgage altogether. You're going to be paying higher closing costs with a cash out refinance, and it's one lump sum at closing. That's cash out. But a HELOC is more of a revolving line of credit, and again, it's 85% LTV, if I'm not mistaken, for HELOCs. Yeah, okay. Yeah, there it is. 85% LTV for HELOCs. It's better because a cash out, you're only allowed to take 80%. And you're only paying interest on the amount you take out. So that you're using, that you're borrowing. It's not like a cash out refinance where you're paying interest on the whole lump sum and you might not be using, $25,000. You take out 50, you spent 30 on your home, and then you have this other 25 that's, sitting around. You're not ready to spend it on your driveway, or not ready to spend it on, disposal of trash, whatever it may be. You're still paying money. You're still paying interest on that money. Paying interest on it. And that's kind of a disadvantage of the cash out. But for HELOC, it's like I said, it's more of a credit card. The only thing is you are subjected to variable interest rates because there are different tiers based on the amount of money you take out against your equity. So I'm not sure I think that's probably, those tiers probably differ with different lenders and different products. I'm not familiar with any of those. If anybody's interested, just let me know. I can definitely find out. But the more equity you take out, the higher you're going to be paying. The more interest you're going to be paying.
Hey, Liam.
Yeah.
Huge benefit of HELOC payment. If you're going to use it to purchase real estate, which is something that we all would do in this group. Most people do it for like home repairs and things like that, or college, but this group would use it to withdraw, make a down payment or repairs on other property, and then immediately refund their own HELOC. It's tax-free.
That's correct.
It is a huge benefit of using money that otherwise will get taxed.
Yeah. May be able to receive a tax break. I did. Now it said I was reading, it said something that may not always be the case. Do you know what point that would not be, tax deductible or something like that?
You're talking about a HELOC funds that you were to use to buy something?
Yeah. Or
I think they're referencing what you buy might and almost always will be taxed, but the money that you're using in your HELOC is money you've already paid taxes on at some point in your past. So there might be taxes and fees associated with forming the HELOC, but the money itself you already own. It's no different than you taking cash and doing something with.
Okay.
I'm not sure of a situation unless Brian or Rich, do you know of a situation where HELOC withdrawal would be taxed? I don't think it can be.
No, it can't be taxed. What I would suggest though is if you're going to use a HELOC to finance another property, I think you might want to talk to your tax or your accountant to determine if the money that you use out of that HELOC can be somehow deducted in the form of taxes as you're buying an investment property in some way. So I don't know the answer to that, but if you're doing it all for the purposes of real estate, you're going to be able to deduct the interest that you pay on that HELOC. when you're paying it back. But if there's a way to use the capital from the HELOC in the process of purchasing another property, I don't know whether or not there's a way to make that tax deductible, but I think you should talk to your accountant to see if there's a way to do that, especially if you're using entities, LLCs, corporations, things like that, trusts. That makes sense?
Yeah, awesome. Thank you. That's huge. That's big. But yeah, you can usually get these HELOCs for lower interest rates than a typical credit card, so that's a bonus. You're going to be looking at shorter terms than a traditional mortgage, usually 5 to 10 years. Yeah, like I said earlier, 85% LTV rather than 80% for cash out refinance. You can maintain your current rate, but like I said, you might be subjected to different tiers if you pull out different amounts and get closer to that 85% LTV. And these are just some of the cons. Like I said, you'll be subjected to variable rates, much shorter term, 2 payments instead of 1. You're not going to have a new mortgage like if you were to take out cash from your property. So yeah, that is my presentation on credit and some HELOC and cash out refinance. Are there any questions?
No, but the next time you're going to have to cover commercial.
Okay, that sounds good. I will do that.
Because I think one of the issues, or one of the things we run into from an investor perspective is we create entities, and these entities, we may want to reuse them or
Hello.
what have you.
Hey.
Hello. Hey, Brian.
Yeah. Okay.
I think Brian has a phone call.
Well, that's probably a good idea because it's concrete floor.
And that's the other thing that I was going to tell you about.
Mhm.
The black tile that's underneath the old original.
Okay, I think
There we go. Force mute.
Yeah, but Liam, that's what I'm thinking is it. Yeah, mute him out. The commercial side of it, we all have entities, LLCs, corporations, things like that. And we know, I discovered that, this is for the benefit of everyone here. I discovered that, commercial credit is nothing like personal credit. In the sense that you don't really have a credit score per se for a business. You have your D&B, that is your Dun & Bradstreet. You and essentially the rules behind commercial lending are so completely different than personal lending. In fact, it's actually somewhat easier, as I understand it. So that's something that I would want to learn more about. And then what exactly do we do to establish a entity from a credit standpoint to be able to use? Now, I know that one of the things you do is you go out, you get a credit card for the company. And yes, you are personally guaranteeing that credit to some degree. And you do that for a couple times, and you get some variation in the types of loans and things that you do for those for the company. And then after a while, it does tend to take on its own life. And you can then, do some things with the company in terms of being able to establish or utilize credit. So yeah.
No, thank you. No, that's huge. That's weird that you say that commercial credit is actually easier. I wouldn't think that. And did you say DNB or DMB?
Dun & Bradstreet.
Dun
& Bradstreet is one of the things that you would get if you're, it's not really, Matt, Dun & Bradstreets aren't really credit. It's really just putting your name out there as an entity or business, right?
Well, in a sense, it is credit because it's your business's credibility. When we created our Dun & Bradstreet profile, the way you do it is you go on the website, you enter your company, your EIN number, and then you upload your balance sheet, profit and loss, and then they evaluate this through time based on your business's debt. If you have debt, LLCs are different because you have a lot of personal things tied into your LLC. But over
Right.
time, a corporation can get a business credit, and there is numbers associated with that. It's nothing like the personal
Right.
credit scores. But when you go to get a line of credit on your business to buy a 12-unit building or to buy a new dump truck or something, your Dun and Bradstreet profile will be more legitimate than if you have a personal credit. And the benefit
Right.
of that
Right.
is you don't
Exactly.
need to use your
And that's why.
personal credit.
Right. That's why I say, Liam, it is actually, when I say easier, I mean in the sense that the requirements are not as restrictive. The bank basically looks at your business and they look at everything from whether or not you have an email, get this, an email address to a domain for that business. That actually matters. Whether or not you, like Matt said, uploading the P&L, and basically, getting yourself out there as a company makes it easier for a lender to determine whether or not you're legitimate or not, or you're not just a hobbyist.
That is interesting for sure.
Yeah, check it out.
There are a bunch of my professors here. They're master accountants, masters at that type of stuff. It would be very easy to find that information out in a couple seconds. Just a matter of setting up a time to meet, and I could pass that information on to you guys for sure.
Liam, that's another good point for you and Ryan. I know Brian, Rick, and Richard all kind of have this going right now too. If you have any interest, I'm sure you do, in investing yourself, and Ryan, he and I have spoken at great lengths about the LLC subjects or even corporations. Highly suggest getting it started early. History is everything. So even though you have a new LLC in a year, it's not going to be new, even though you've done nothing with it. According to the Bureau of Organization at the state, it's a year old. There's some credibility there. So if you have an interest, you're going to be doing this in the future, get it in there, get your name seasoned so it's not brand new, so that when the time comes, at least it's there. And if you need help with that, I can help you. Rich can help you. I know Brian's done it before. It's very, very easy to do, very simple. Doesn't really matter what your name is. You can change it if you want, but just to get some history there is important. And
I would appreciate that a lot, actually. Thank you for that. I will definitely be reaching out to one of you guys, probably over winter break coming up here. So I will definitely be doing that. I appreciate it.
Awesome. Do you guys have anything else for Liam or any other information you wanted to present?
No, that's good. As long as I think we'll have Liam's contact info for later, right? Yeah. Okay.
Yep.
Awesome. Thank you. Really appreciate it.
Of course.
Thanks a lot for the information.
Are you going to hang on for the rest of it?
Of course. I need to watch you now.
Okay. Well, nobody wants to listen to me. They all listen to me talk all the time. I talk to Richard more than I talk to my wife. She thinks it's hilarious. All right.
I have nothing to do with that. Okay.
Yeah, right. Yeah, 50% of it, right? 10 by 1. All right, can you all see this fancy presentation I have up here?
Yes, looks beautiful.
That is New York City taken from the top of the Empire State Building on my anniversary. There's nothing cooler than looking at every single one of those things, those buildings out there, realizing that the smallest one has 10 units and the biggest one has God knows how many. And a year before this picture was taken, it was a total ghost town. So empires can fall, crazy things can happen, but we're all in this for the long haul, and just education is really all that matters. So I wanted to show everybody. I have a lot of cool pictures here that I've accumulated over the years, but this presentation is more so based on my experience with some data backed up by the sources, mainly National Association of Realtors, which is the one that we reference for most of the data because it is peer reviewed before they publish it. Anybody can Google search the stuff, but if you have any questions, just feel free to stop by. This is about the current state of the market, specifically to Eastern Pennsylvania. I know we have guys kind of all over, but it's really hard to report on the general market of the country because there's so many different ones. The market in Orlando is so much different than the market in certain parts of Texas and Idaho and all that. But in general, this is where we stand. So the fall of 2021, the information is just now starting to come out for the fall. A lot of the reports are from late summer. So a lot of these data points you'll see are not specifically to this last month or two. However, I think that you'll get good value from this. There's a lot of influencing factors when it comes to real estate and the value of real estate. We have job growth, local economies, home sales. It all plays into it. But there are a few factors that really matter when it comes to what's going to happen. And as an investor, that's what you care about. Liam, as a lender, you want to know what your future is like as far as the clients are concerned. And Brian is going to want to know where his next deals are. And this is all going to show in these factors, which you won't be able to see right away. You're going to have a lot of things that you have to track to kind of keep an eye on them. And some people get it wrong. This news article I put in the picture there, the sky high housing won't fall. That was in the money section of USA Today. And who really knows? I mean, you have to be prepared for anything. So the fact that the experts are saying they're going based on data that they have. And we all need to just do what's best for your individual business, because finding a tax sale property like Rick does might be a little bit different tactic in tracking the market than a lease to own property that Brian does. So everybody has a little bit different ways they track the market, but as long as you're doing it, that's all that matters. You don't just want to sit there in the back and on the sidelines and wait for things to happen. Anybody have any questions?
Sorry, go ahead.
Go ahead.
No, I was just going to say, for local economies, you can look at job growth, population growth, the amount of unemployment workers in a specific area. To judge all these, you could go to census.gov actually, and you could find all this information by state, and you can compare it to the national averages of the country.
Yeah, that's good. You can invest in an area that's climbing. You can invest in an area that's bottomed out. There's a lot of different tactics, but it's all based on what your business wants to do. What I'm going to present are the factors that we have access to in the MLS and how I see it firsthand changing opportunities for not only new investors. Ryan, I'm working with specifically, we've seen things change a lot. As an agent, but also as an investor myself, you need to know where to look for opportunity and maybe kind of change your plan based on the way things are going. So some individual factors that we see that make a big difference. Days on market, as things climb, it's a sign that there's either more inventory or a lack of demand. That's happening right now. The data here is showing that, and you'll see it in the following slides. But as days on market rises, things start to plateau. There's not a demand. Price per square foot, as you see the same house in the same area climb in price per square foot, you're paying more for the same product, which means your money goes less distance when you're buying anything. And then a good key indicator is real estate owned or bank owned inventory. When you have lots of bank owned inventory, that's not a good sign. 2008, lots of bank owned inventory. Now there's very, very little. And I'll explain why that's important in the future. And then the need for rentals as an investor, unless you have somebody renting that from you, nothing else matters. It doesn't matter if you have a 100-unit building, if it's sitting there vacant, it might as well be a big hole in the ground. You have to have a need for renters. So here's job growth as we see it throughout the states right now. This looks to be a little bit of a a broad image, but this is directly from the National Association of Realtors, which again is where I try to base all of our data from. You can see it's growing in a lot of places. There hasn't really been a decline according to them, but there's a huge gaping hole in the Midwest. I'm curious to see what the data is there. Job growth and employee growth are not the same thing. So we're trying to figure out what that issue is with employees, where they're going, how these people are filling it. But it seems to be a push for people who are going out and being more entrepreneurial. You're not going to have all the Burger King workers if they realize they can make more doing less for their own terms. So job growth is a key in real estate to seeing trends before they happen. The national average is about 2%, which is you look at appreciation, it follows the same line. Pending home sales is another big thing, also a graphic from NAR. Pending home sales show a market region's health, but it doesn't really show exactly what's happening, because pending is just that. They're under contract. They're not sold. Sold is the only thing that matters, and we'll get to that in appraisals in a little bit. They are actively under contract and a month-over-month average. The less the inventory, the more competitive the market. The more the inventory, less competitive the market. So it's kind of converse there. And you can see how the different parts of the country are exploding relative to others. The South, Florida, people are flocking warm right now like crazy. And same thing, Midwest. People are getting away from California. They're all flocking to the center of the country. Idaho is seeing a boom that's like, if you listen to the Bigger Pockets guys, they are just flocking away from California like nobody's business. Taxes, restrictions, and there's so much opportunity in the Midwest. So Northeast is good. Everybody has their own little areas where they prefer to invest, but just a graphic to kind of show you there where people are moving. I'm going to reference the Lehigh Valley for a lot of the following slides because it's what I have direct access to. I can get really detailed information from the Lehigh Valley data and our MLS. The average home buyer in this area is 44 years old with an $84,000 income. It doesn't differentiate whether that's W-2 or not entrepreneurial income, so it could be both. These are 2 years old data, so it follows census data and MLS. The ages are mid 40s to 50s. That's where the average age of this home buyer. It does bring race into it, which is a statistic. It's not a segregation thing, but predominantly in this area, the race is listed there of who's buying homes. Marital status, whether they move within the same state, moving out of state, it's usually a huge shift. This is showing that there is a huge influx of workers and people buying homes into the Lehigh Valley, which is good information to know. If you go into a different MLS down in Philadelphia or a bright MLS, this data would be different, very different. But for investors who are local, this is very, very important information to know. Anybody have questions so far?
So, Matt, so you're saying that right now it's growing in Lehigh. Is there a reason why, or?
So the reason for the Lehigh Valley growth, now this is purely opinionated, but backed up a little bit by actual data. The Lehigh Valley is the out for everyone in the Northeast and South. Philly, New York, everyone is flocking away, and COVID really accelerated that. Lehigh Valley's cheap living, cheaper than where they're used to. Land is cheap. Development in the past has been cheap. But what it's doing is it's really invigorating the local economy. There's job growth. There's people flocking from all directions. And because of that, it's really making the land and the investment potential here high. But it's also taking away good opportunity.
Yeah, isn't it also pricing out the locals?
It is because, Joe Schmo from New York can come out and buy a house in the Poconos, no problem, for 50 grand more than it's worth. And it is causing an issue for people that live here because you have people who desperately need housing. That's the other thing. Rental stuff here is very, very in high demand. And you're having trouble finding people who can actually fill those shoes to compete with the people from out of state. And it's quite an interesting scenario here. Ryan, I'm going to bring him in the conversation a little bit. He's seeing that kind of firsthand.
Okay. Yeah. So you're saying that because of the influx of new blood from New York, Philly, some of the larger cities, that's of course driving up market prices artificially, I might add, and pricing out the locals. I'm not sure I'm understanding where the jobs are coming from, or is it because of more people working from home?
More people working from home, but that does not influence the local workforce. There's a huge lack of workers in the Lehigh Valley right now because there are so many blue collar jobs. It's not like the Bethlehem Steel is employing the town anymore. You have Amazon built massive distribution warehouses. FedEx built the largest warehouse in the country a mile from our airport. There is huge industrial development here, which in turn is bringing not a lot of employees, but a lot of support for those development projects. And the people are moving here to work elsewhere. But Richard, you're right. I don't see the job increase, the active, educated jobs that you would think.
Right. I mean, you don't have a technology park, for example, which a lot of cities do, such as Charlotte, Atlanta, things like that. And Lehigh Valley, you don't have that. You do have a lot of industrial blue collar type jobs. I would be curious, though, as a comparison, to hear from Brian I don't want to put him on the spot, but I just did, what he thinks of the market fluctuations or the things that are moving the market out his way, because that's Western PA. And I can tell you in Central PA, there's nothing here other than, just an artificial increase in housing prices as much as 8% above the running rate year over year. So.
Yeah. So Richard, I'm not an expert, in trends, but I do think Pittsburgh seems to be, growing. And if you look at Metro Pittsburgh, no, it's been pretty stagnant. But if you look at all the areas around Pittsburgh, there's a lot of growth from universities, from medical, high tech, Carnegie Mellon and Duquesne, Pitt spinning off a lot of companies. Right. Uber has 1,000 engineers in Pittsburgh. So the demand here has been pretty strong. I don't know the details on job count, but I do know it's the way that Pittsburgh is growing is more toward the north up in my direction. And I'm benefiting from that. It's sort of, coming up into Cranberry Township and either further north into Zelienople. And I'm right in the path of that sort of growth. So that's benefited me.
Well, understood. Thank you.
Yeah, but it's not just, it's pushing things out further because as they go up and they look in Cranberry, they're priced. A lot of people are priced out of there too. Now, they weren't before, but so you're seeing, Monroeville and, Murraysville and Greensburg in that area going through the same thing where prices are going through the roof. So, and then Washington County is another one, to be honest with you, Allegheny County is a very tenant friendly county. And so, so what I've seen is that, kind of in our, where I'm looking now is Westmoreland County primarily.
Well, interesting. And my wife and I, Anita, are, of course, looking for properties and one for ourselves, of course, as well. And we found something out in Johnstown. Remember, everyone knows Johnstown from the flood, right? It was a beautiful property, and it was priced right, but the taxes in was it Clearfield County were like $10,000, and I could not believe those numbers. So I had to go to NACO and the county and look at the county's website for Clearfield and tax assessor's office, get the mill rate and all that. And you can calculate this stuff out because that's the benefit of taking your real estate licensing class. I may not be able to do this again in another month, but calculating I'm seeing tax rates increase as much as 12, 15% in some of these counties. Now, I haven't done the numbers to say for every county or take a sampling of counties to do this, but we've looked at a lot of properties, and I'm seeing like even the Lehigh Valley taxes going up much higher than I think they probably otherwise would be in a normal market.
Yeah, I would agree. Compared to when I went out to Arizona recently in October, like our taxes are definitely, it's an East Coast thing, I think. East Coast and California, obviously, but we definitely pay higher taxes, and I've seen, it going up, which in parts of, because I'm close to Johnstown, and that town, there's not the job growth, and there's, the younger generations are leaving to go to, Pittsburgh, which is 2 hours away, so because again, there's just a ton of jobs there right now. But I think what they're doing in a lot of these cases is raising taxes to come up and cover the shortfalls because they're losing population.
Yeah, agreed. Sorry, Matt, we didn't mean to usurp.
No, that's okay. I love the conversation. That's exactly, Rick. I think that's what they're doing. There's a shortfall, and especially in older communities, there's less of a push for tax increases to keep the fixed costs as low as they can for the people on fixed incomes. However, it starts to create issues where these municipalities can't afford to replace lawnmowers and rock salt for the winter and replace roads, and they have to do something, which is why I feel we're seeing this boom of warehouses around here, which provide a massive tax relief, but also a huge eyesore. And it's kind of a catch-22. What do you do? But taxes,
well,
go down and fix it.
Yeah, but the worrisome thing, taxes never go down. I'm sorry.
Did you see the sign or did you see it online? I'm just kind of curious.
You got to kick him off again.
Busy guy.
He's making bank today.
Matt.
Yes, sir.
The worrisome thing about all this, I think what I was trying to say earlier was that taxes never go down.
Of course. No, why would they?
So, with these inflated numbers, with these tax increases and things going on, I think we're going to eventually see normalization with more properties coming onto the market, largely from foreclosures or people selling, that sort of thing. But as that happens, the tax rates being higher than they otherwise would be is also going to affect the competitiveness of the market overall, I think.
Can I ask a quick question?
Yeah, what's up?
If you guys said that the tax rates are rising due to a population decrease, right? I believe it's Johnstown, you said, that people were fleeing that area and moving to Pittsburgh. And you also said that in that area, taxes were rising, right?
Right.
Yeah.
And was that the same? You said the same for the Lehigh Valley, that taxes were rising in the Lehigh Valley, right?
Taxes are rising in the Lehigh Valley, yeah.
So if the causation for the rising taxes in Johnstown was a decrease in population, can't that be the same? Can we say the same thing about the Lehigh Valley then, that the population?
It's probably the opposite. You got more people coming in that are willing to pay the higher taxes coming from New York, Jersey, places like that, where they're used to that. I do think that there is I'm not saying that I know anything about this sort of thing, but I would suspect that the public officials that govern the tax rates are looking at those same metrics that we can see, and they're making judgments accordingly. And that means they can increase taxes because they got more people coming in that can afford it. Well, then, okay, they just have to do it equally across the board.
And there's infrastructure needs when you have people moving in too. If you have population growth and job growth, you have more cars, more roads, more power, more utilities, more everything that needs to be upkept with tax revenue. Then you have police and fire and employees for government that all cost money. And at one point you get used to those numbers, and you're not going to go backwards and say, okay, police department, last year your budget was $1 million, this year it's going to be 500. That's not how it works, right? You're almost at a point where tax rising is almost virtually necessary for every scenario. But you hope that your incomes and people's take-home pay rises slightly more than the tax rise, because over time it's the whole cost of living adjustments. $1 how many years ago is not $1 now. And if you still put your dollar in the savings account, it would be worth less. So, there's a lot of different factors that go into it. But yeah, Liam, I think your comparison between the two is valid. You would think it's the same scenario that could be applied to both areas, but very, very different markets.
Gotcha. Thank you. No, that's perfect. I appreciate that. It's interesting.
It is. An economist would probably give a much more detailed answer, but that, from us, that's kind of what it is.
No, I think you nailed that, to be honest. I think that's exactly what, that's definitely a causation. Both of those scenarios would warrant higher taxes, but they're completely different reasons for those higher taxes. And I think economically what you said is perfect.
And Richard brought up a good point earlier. More homes coming on the market, more homes becoming an option. What you'll see here in this slide is the closed sales, this top arrow on the right, are starting to go down. There's not as many closings happening. This is with residential, and residential and then investment properties, multifamily, kind of trail behind in this area, but sales are slowing down. Now, every year you can see on the graph here, closed sales around the holidays do slow down. So it's kind of an artificial thing. Every year there's a cycle around the holidays. But what we're seeing is more and more listings and more days on market. On the bottom, the average days on market, 5-year average is 32. Lehigh Valley's at 17, but it's already gone up to 18, from 16 to 18, which means that the same home has been on the market 2 days longer, just over a month. And if it continues, there will be a point where there's not a demand for the same house, giving all other things if they don't change. So these are the indicators to start to look for. What are the closed numbers doing? What is their price reference to their asking price? How long are the homes on the market? What kind of competition is there for that same home? Whoop. So this is a really good indicator of market activity. You have active listings here back in 2018 and closings. This means there's a lot of inventory and not a lot of people buying the inventory. As time went, 2019, right here's COVID. COVID in the beginning of 2020, everybody bought the inventory that was on the market. The houses were gone. And then at some point, there was more demand or more closings than inventory on the market right here, November, almost July of 20 or January of 2021. More homes are being sold every month and more homes are being listed. And that's a huge problem. And it's been pretty neck and neck ever since. However, the data doesn't exist past September, but we are seeing a spread. They are starting to diverge again in this area.
That's a very interesting graph. That's very cool.
Mm-hmm. So you could tell there's not a ton of competition when these lines are far apart, because the active listings and the closed sales, this is on market properties. This has nothing to do with people selling their house by owner, nothing like that, because that data is really hard to find and hard to verify. This is MLS sourced. So when they are far apart, there's lots of opportunity for people to get good quality homes at whatever price you determine is fair. But that's where the deals are. But when the lines are together, this is competition, hardcore competition, because there's only so many homes being listed and there's a lot of people after them.
So it's not much so that more homes are being closed. It's just that there's less inventory, less people listing. No listings.
Yep, which drives the price up, which drives competition up, and then you get into the cycle, which is why we talk about appraisals in the second half of this. Appraisals are becoming a problem for people because they're used to this false sense of what a house should be worth based on that hardcore demand, and there's really not that hardcore demand anymore. But the house was sold based on comps that were in a high demand. So there's things we all need to get comfortable with here in the near future. Price per square foot. This is the same house. Just pick a house, doesn't matter which one. 5 years ago, $118 a square foot. That same house now is up around 150 in this area. These are residential homes, so if you're flipping or investing, it's kind of what you're going to look at. But that same dollar purchase price in 2016 now gets you less house. And here's where we start to see the data. This is days on market over a 3-year period, 2018 to August 2021. You can see the days on market, the average days on market for a house is really, really low. We're below 10 everywhere in the Lehigh Valley. However, from October, this red arrow, it has jumped and it's starting to see a spike. There is a huge influx of people listing their homes in the Lehigh Valley because they all see that they can sell their house or they can sell their place now over asking price with all these offers. It's going to be great. It still is happening in certain neighborhoods and for certain types of homes. But what's happening otherwise is they are sitting for longer. Sometimes we're now up several days or 15%, 14% of what it used to be. That is a sign over just 1 month that things are starting to change in this area. Do you guys understand what that number means?
Yeah, so so the same houses, if we'd have sold it 2 months ago, probably would have flew off. Now it's sitting there.
Yep. So it'll still sell and it'll sell fairly quickly compared to history. But in 3 months in February, what is this going to look like? Now, you can tell trends based on yearly times, like holidays, things cool down. But this is correcting at more than twice the average rate in a time where there's still high demand for houses. You know, we're still not completely sold out of inventory from the COVID demand. It's something's happening. You know, you can tell there's a shakeup coming. And
I'm sorry.
No, go ahead, Liam.
When you say shakeup, what do you mean exactly?
It's called a shift in real estate, and it's what the agents and the lenders are all kind of tuned into. When the market shifts, it can shift in a bunch of different ways. It can shift down, up, where you have more inventory, less demand, or the opposite. Now, a shift is really just a fancy word for a change. But as an investor, you have to change how you're going after these properties if you're going to stay ahead of the curve, because you do not want to buy a place now in a hot market if there's going to be 10 others just like it that aren't going to sell super quick down the line, because then yours is not really special, you know. So you have to look at these indicators before you get involved in whatever you're getting in. Does that make sense?
Yeah, that's very interesting.
Well, I also think it depends on what your investment strategy calls for. Are you doing it for long-term growth, or if you're doing it in terms of flips? What Matt just said specifically applies to things like flips. But if you're doing a long-term strategy where you're going to be renting out a property for a period of time and rents are up, then you still don't want to pay retail. Of course, you want to manage those numbers. But it is probably a good idea that if you can get a multi-unit now's the time to do it.
Oh, for sure. You're absolutely right. Because appreciation is always going to happen. You know, real estate will depreciate at some point, but not over the long term. It's not going to take a cutoff like a stock, because a stock can disappear without anything to show except an empty bank account. You can't disappear a 5-unit building without some serious legal action and hurting people. So this,
Hey, Matt.
yes,
So where do you see inflation impacting this?
all over, everywhere. However, inflation, what we see first is really kind of masked as demand. COVID started the inflationary period. We're starting to see the interest rates rise, or they've leveled off. Now they're starting to rise. But as far as inflation to an investor, we haven't seen rent rates like this in the last ever. I mean, Brian talked about the lease to own thing, how he is renting these homes for, I think he said 10 to 15% more than what the average home would rent for, just for the lease to own purpose. But in the Lehigh Valley, there's rentals, not even rent to owns, where the rent price is inflated itself, but there's no sign of slowing. So I think to kind of answer your question, it's inflation is evident in every part of the market, but the rates are starting to increase, which will start pulling people out of their either comfort zone or their ability to buy the same property that they would have 6 months ago. And you can get a 15-year mortgage for 10 or 1%, 2%.
And so are you, I mean, because what I've also heard is that, there are foreclosure, that the banks are starting to hire people to do foreclosures again.
Mm-hmm.
Have you heard anything about that?
Yes. In fact, I've heard it from lenders specifically. One guy we had on the meetup a few months ago, he did bring that subject up, but I have a very hard time believing anything I can't see with data. And that's a fault of my own. I need to be, I need to see it for it to work, and understanding that it trails a little bit. This graphic is fantastic to explain exactly what you just asked. 2011, all the way on the left, a few years after the crash of 08, where there was this huge void. If you could extend this graph, the data doesn't go back that far, unfortunately, but if you could extend this graph to 2008 off the left side of your screen, that yellow line would be pegged all the way up at the top end of this chart.
Yeah.
Active foreclosure listings versus sales are the blue line. 2008, there were so many properties, they were flying off the shelves. Literally, people were being removed from their homes. And then as the decade went, the line kind of compressed. Then again, in 2016, there was that minor recession. You could see that as the lines separate, that's where there's opportunity for foreclosure investing. But it's also where things are unstable. The last 5 years since COVID, they have actually gotten so close and so tight, showing that there is virtually, I don't want to say no, but very little foreclosure to sale rate, which doesn't mean foreclosures don't exist. It means that the competition for those foreclosures is very, very fierce. Everybody and their brother has access to a Zillow pre-foreclosure notice, which we all know is complete and total bullshit, right? It doesn't mean anything. It means you missed a payment, got filed somewhere. Now all of a sudden, the world knows that you might be in default. Ooh, we can get that $500,000 house for $100,000. Not the case.
I can speak directly to some of that, Matt. As I've attended a few foreclosures sales here in Dauphin County, and I can tell you that it is quite competitive. There are a lot more people there than you would normally expect. They're using courtrooms to get all the investors and people in there that wants to buy some of these properties. Now, a lot of them get deferred or they get pushed out to other sale dates. I'd say about 40% of them are like that. And I'm not sure what the reasons are behind that, because I wouldn't think it's moratorium related, because it's already gotten to the point of sale. But then the ones that do sell go for way more money than they're actually worth. And remember, these are largely properties that are unseen. Okay, you either got somebody still in there, the homeowner themselves, or if they are empty, you can only imagine that what the condition might be inside, because they didn't leave happy. Okay. So, but going to these sales, the prices are sickening. In fact, I stopped going because of the inflationary prices of some of these properties. So
Richard,
there you go.
That's a good point. And Rick brought up earlier, what are the indicators? I'm having a very, very hard time. And Richard, you even said it to me in private conversation. There's going to be this fall off or this cliff where we're going to have this opportunity to buy again. And because of exactly what you just said, I'm having a hard time believing it. Again, I'm not giving anything other than my personal opinion here. When you have the amount of foreclosures, this is a direct real estate owned graph from our local MLS. When you have little foreclosures compared to the past, and you have high demand for those foreclosures, and you have Richard at these foreclosure auctions, and there's just crazy competition, why is there going to be a cliff all of a sudden of people that are just going to be throwing their homes out and people just buying them up for nothing? There has to be a cool off period before that. Who knows what that is or how long it's going to last, but there is a recession coming of sorts. Go ahead. Sorry.
Oh, no. Go ahead. I'll let you finish your thought. I did have a comment on that. I think I have right. I think it's going to begin with the bubble bursting. Okay. We are in a bubble. Let's just admit that. All right. We got a bubble going on. When more inventory comes on the market, that bubble is going to either be deflated slowly or it's going to pop. Don't know which. But when it does, and with the inflationary pressures as they are, people are going to want to have their housing more affordable to them than maybe in the past. I think it's going to be an issue when people like Liam have to do, calculations on, DTIs for some of these people who are largely living off credit cards now and through COVID. And now they got to sell their house, more inventory comes on board. And the next thing you know, we're going to have a correction. Now that correction could come 6 months. I'm thinking really summer next year, we'll see some significant correction, more properties on board. I think the political climate is such that there's going to be attempts to try and make things better. I don't know how successful that's going to be, but I think there's going to be a lot of hype around that time. Nevertheless, once those properties, those inventories increase, I think you're going to see this yellow line take off north, and in part because of people that are going to be getting thrown out of their houses. They can't afford it.
Yep, I agree with you, Richard. However, I also think that there's so many people waiting on the sidelines to start taking advantage of these, that before it goes too low, and before, if the five of us were sitting in a room waiting for all this to happen, at some point, one of us is going to bite the first bullet as that yellow line starts creeping up. Somebody's going to buy it. There's all these people waiting in the, the side of the stage, waiting for their investment opportunity, a lot more than normal. So before this thing tanks, you're going to have investors jump on the market for less price than it's worth now, but still good to them. And I think personally, as an investor, I see we're going to start seeing shifts in local economies to being heavily investor-owned, tenant-occupied properties in a lot of the country, because the tenant-occupied portion of it are not really able to control their own finances anymore because of COVID and all the effects that have happened past that. But yeah, I want to try and finish this here. So I think this is a really good opportunity discussion for the future. I really like this stuff that we're talking about, because everyone has really, really good valid opinions. And if you talk to me out here and, Brian on the other side, totally different backgrounds and actual markets. So,
hey, Matt,
yes.
I just want to mention, I saw an interesting statistic that in the George Bush era, 66% of Americans own their home. And by the end of Biden's first term, that'll probably be down to 60%. So we've gone, we're moving more and more closer to becoming a renter nation. as opposed to a home ownership nation. We're 60%. So if we drop 10%, we'll cross over to where more people rent than own.
Can you find that and send it to me? I'm really, really curious about that because
I think I heard it on a podcast, but
okay.
If you Google it, you might be able to find it. I have no idea where I saw it or heard it.
The wealth
I just
gap
remember it
is a real thing. You know, the top 10% own more than the bottom 90, and it's just getting further and further, which includes real estate. As the opportunities come, who's going to buy them? Not the people that can't afford them, but the people who can. And then they have nowhere else to live, so they still rent. And the problem just exacerbates itself. But really, really cool graphic. I thought you guys would appreciate this. Again, straight to the Lehigh Valley. It's different in every market, but you know, you got to learn what you live. So
I will say, just to add to the inflationary measures, I know Jerome Powell spoke last week and it was around like 6.8%. And that was off target by like, he wanted to maintain 2% inflationary rate over I think 20 or 10 years. And he was way off. And we're talking about in our class now, there's not much the Fed can really do with monetary and fiscal policy to remedy the inflationary pressures. One, because of the debt limit and the debt ceiling. And America's in severe debt right now, and if they just keep lowering interest rates, we are going to experience some hyperinflation event. But I mean, if they do increase interest rates like we saw in the 70s, where there was double-digit, interest rates, America's also has to pay those rates on its own debt. So if that happens, America's debt is going to increase by that rate as well. So by keeping rates low, America's debt is manageable. But as soon as we raise rates to try and fight inflationary pressures, America's debt also increases. So that's just another thing to keep in mind when you're thinking about this sort of stuff. I just thought you guys might like to hear that.
Oh, that's good information. Thanks, Liam. So all these stats are great, but we're all investors. What does it really mean for us? Ryan is seeing firsthand multi-units are very, very competitive. Unless they're falling apart or somebody off market, you can't just go buy a 4-unit because they trail behind. The market for those is still very competitive. A lot of investors are entering the market for the first time, and the owner occupants and people who house hack are buying a house, repair it, and move out. That's becoming extremely popular. It's a very heavily investment-driven game now. Available rental units in this area, at least, are low, which is keeping the prices high. And you're having a lot of people who've owned real estate for a very long time cashing out as prices are high. Some of them are asking even unrealistic prices. And part of the appraisal information I'll share shortly is a local investor who owned a 3-unit, a 4-unit that Ryan was going to buy, and it kind of backfired because they're asking too much, and it's just an unfortunate scenario. Oh, there we go. So when you start investing outside of your area, things kind of change. This is a street in Telluride, Colorado. We get out to all the time. It's gorgeous. Little town was built in the middle of the mountains as a mining town. 50 years ago, nothing was here but a few streets or a small street and some buildings. Now it's one of the most exclusive towns in Colorado. And you cannot find a little tiny house for less than $1 million. It's crazy. You don't want to invest in a place like that unless there's a need for it. But in general, slowly increasing inventory across the board, which is a sign, decreasing the competition over the long term. But it looks like good opportunities for people, specifically home buyers first, and then investors secondly. But as an investor, you have to find a good deal, and you don't want to spend money on something you're not going to profit from. So the way we're finding ways to do it are direct marketing, mailing to the sellers, cold calling, walking neighborhoods. We have a local portfolio liquidation by local investors. So getting out there, meeting people who are local is super, super important if you want to invest in your own town. But if you're not, you need to be able to find a way to do these things somewhere else that's going to work. Those areas are really up to subject of what your returns are, what you want to invest in, and the areas you want to invest in. but a place like Allentown, Syracuse, and Fort Wayne are not Atlanta, Boston, New York, things like that. Different investing strategies for different investing people. Appraisal problems. We've had several appraisals tank expected values lately, which is something that I think you all should be aware of. The appraisal, we all know what it is. It's an estimate to determine market value of a home. It's not anything other, excuse me, it's not anything other than the actual opinion of the person who's doing the appraisal. Lenders require professional appraisers to make sure that they are not buying something more expensive than it's worth. Lenders are also prohibited from talking to the appraiser directly. They have a third party that they work through. And what happens is they talk through like a program or something like that to get information from the appraiser. But because of 2008, there are very, very strong limitations on what a lender can't do with an appraiser. Your real estate agent is not limited by that. We can talk to the appraiser directly. They don't have to answer. A lot of times they don't. But when Ryan's house was being appraised, we weren't getting answers quick enough. I'm asking, hey, what's the deal? What's the deal? What's the deal? And sometimes they respond, sometimes they don't. You want to avoid issues with an appraiser or with an appraisal by avoiding these 5 areas. If you don't think the property's worth 300 grand, don't offer 300 grand. But if your comps and everything that you're working with, the agent you're working with, or the information you're provided shows that it's worth that, offer what you think is fair. If the property has deferred maintenance or repairs, that's all going to be noted in the appraisal. And if there's issues with habitability or your ability to live in and occupy the property, that will affect its appraised value. Appraised value is a snapshot, just like your credit is a snapshot right now. Appraised value is a snapshot right now of what that property is, not what it can be after you fix it. If there's a property that's so unique, there's no real comps, that also can create issues with a low appraisal. And there's really not much you can do about it except offer suggestions and comps to the appraiser, and you can fight it, and we'll explain how to do that in the future slides here. If the area is in decline, if you have a huge employer that closes a factory and employed 90% of the town, that's a big indicator to what the home's going to be worth in the future. And the lender might not want to take on that risk. This should look familiar to Ryan. This is Ryan's appraisal. In Whitehall, 3-unit, really sweet looking, beautiful property, very well taken care of. Seller was asking a number that was listed prior, and she needed a number at the end, net profit. So based on some comps that we did, we determined that it was a fair offer price of the mid 300s. And the appraiser determined that was a lie. They did not want anything to do with it near purchase price, and they came backwards. So regardless of what your sales price says, the value is going to the appraiser. They will take the lowest of multiple appraisals if it comes in and you need to do more. They evaluate current market, and they only base it on sale prices. They don't base it on current properties for sale. They don't base it on private sales off market. They don't care what Zillow says. It's all sold comps through the MLS. Everything plays into the appraisal: size, location, time on market, neighborhood zoning, what it can be used for, bedrooms, bathrooms. And if it's a multi-unit, the rents are determined at market rate or whatever the leases say. If it's a 3-unit and only 2-unit are occupied, they're going to show the rent on what the 2 units would be at market rate. And the market rate is the determination of the appraiser, not of what you show. If you want it to be calculated on what it's rented, you have to show them the lease. They will get copies of the leases. If the price comes in low, all these different factors apply. 2,000 square foot home. They talk about price per square foot. This is one area that we found that has been very, very accurate lately. Price per square foot compared to comps. My closing slides in a few minutes, we'll talk about a place that I had in a little town north of the valley. 2 appraisals, 50% difference in opinionated price between the 2 appraisers. It's baffling. And in the end, the deal fell apart. But price per square foot is where they come back to it very, very heavily in residential. But when it comes to multifamily and investment properties, they go to cash flows and gross rent multipliers with bigger properties, 5-10 units and higher. They're going to go on gross rents. And there's calculations for all that. If there's deferred maintenance problems, houses falling apart, it's going to be a problem when it comes to appraisal time. They're going to have a condition report. They're going to show poor, average, or above condition, and they're going to make notes. They're not going to tell you how much it's going to cost to replace all the windows. But if you have an FHA buyer or someone who's using VA or USDA, there is going to be issues if the paint's cracking, if the roof's leaking, if there's foundation problems, if the basement is dirt, if it has knob and tube wiring, things like that. There will be problems with an appraisal. So know going into it what you need to have in order for them to issue an appraisal. Most sellers, if they are represented by an agent and they know the home has problems of a certain level, may not even advise their clients to accept an offer with this kind of financing. Have you guys had any issues with this before?
I found that an appraiser who's appraising a house for a purchase, to me, will give a higher value than on a refinance. I think they have a lot of incentive not to overshoot a refi on a bank. But when they're appraising a house that you're buying, they know what you're offering for it. And that sways their opinion.
Is that right? I agree
seems
with
like
you.
it to me. Yeah, seems like it to me.
I completely agree with you, but should they be entitled to that purchase price is what I think I'm asking.
Well, it does sway their opinion. And in fact, I just had an appraisal done recently where, he'll ask the question of where, what are you looking to, not what you're looking to pay for this, but what do you think it's worth? He'll ask that question. And I give him my opinion because, it's just an opinion. And he came back with, something close to that number. That's happened to me twice. In fact, it happened with the townhomes that we sold earlier this year where both numbers, 2 townhomes on the same block, 2 doors down from each other. We're selling both of them to the same investor, and both numbers came in. I believe they said on, I can't remember what the term was that he used, but on the number that we were selling it for.
Yeah, I've been lucky. I've never had a house appraised for less than I'm offering, but I've had a ton of them appraised for like $300 more than that magically. So that's just the way it goes. Hey, Matt, I got a 1 o'clock meeting I got to prepare for. I got to dive out. So
hey, Brian,
thanks.
hey, you should be an appraiser. You're really good at that number thing then.
No, thanks.
Yeah, we're going to wrap up here shortly. I just got a few more.
All right.
Thanks, Brian.
Thanks, fellas.
Later.
Me as well. I have a class at 1. Thank you very much. I'll
see you, Liam. Yeah, so habitability. This is a house from one we looked at with Ryan. Extreme deferred maintenance or concerns. Foundation repairs could be huge. This house had massive cockroach problems. They had asbestos. They had pipes leaking. We shouldn't really have been there. But just for what it's worth, this unfit for habitation is a concern. If it's a unique property without local comps, this is a strip of homes in Jim Thorpe in the historic district with varying price points from $500,000 to $50,000 in the same strip of homes. 0 parking on any of them. It's going to be a problem when it comes to resale. Your opinion of value versus your neighbor's opinion are varying numbers. So if if that is a problem, you want to make sure that you have someone who can educate you in what the property is really worth. Declining market. If there's a declining market, the appraiser has to take those local economic factors into effect or into account. They have to get a little bit of protection for the lender. The lender can then ask for more money out of pocket, and if you don't have a difference, it might be the difference of losing the deal or not. Surprise findings during an appraisal. Huge. There's asbestos. Disturbed asbestos is the big one. The fact that it's there isn't really that big of a problem. Disturbed lead-based paint or disclosed. If it's disclosed from the property owner, you might as well just let it sit on market, because not many mortgage companies are going to touch it unless you can fix that problem, and it's going to be very, very costly. So everybody here knows about asbestos and lead-based paint and their hazards, but when it comes to buying a home with them, there are certain ways to and to not navigate that. Avoiding a low appraisal, you work with an experienced agent or lenders who give reports. Write an offer based on your data, not based on what they're asking. You can't work backwards to make sure they get the dollar they need, because we found out firsthand that Ryan's property, although we felt it was worth that, the comps and the rents were valued, the appraiser just came in, and regardless of the market and how hot it was, they couldn't make the numbers work. And in the end, it was a beautiful property, but it allowed him to move on. Work with a lender you trust and has a proven track record with this kind of stuff. They each have their databases of appraisal groups they can use. However, they cannot pick which appraiser goes out and does the appraisal. 2008 kind of stopped that, and it's a good thing it did. So, and identify local concerns that could be a problem. You just want to avoid getting caught, because you're going to waste a few $100 for an appraiser and a month or two of everybody's time. But then surprises do happen. You can fight an appraiser. Use legitimate comps from the MLS. You can send them back to them. They do not have to take your comps into consideration, but you could always send them in. If there's a second appraiser ordered by the bank because they think the first one's really bad, they can do a full second appraiser or a field review, which is basically a drive-by appraisal. If there's no agreed upon numbers, you can go above and beyond with a cash offer, which is not a good idea for investors. Not a good idea for anybody. However, people are doing it because they have no place to go right now. And your offers have appraisal contingencies, which means, can you bail from your offer without losing your down money if it does not appraise? Every single offer should have that in it, because if it doesn't appraise, the bank's not going to lend you the money. This is the one I was talking about, conflicting appraisals. Appraisal 1 on the top, $88,000, August 31st. Contract price was $87,000. Same house, 1 month later, $46,000. Same house, nothing changed. This is a problem. This deal fell apart because the bank will only lend on the lower of the two numbers. So just be mindful. If you're looking at a home in a small rural area, there might be conflicting or lack of data from the MLS. So just kind of keep that in mind. And some last notes about appraisals. They're paid out of pocket during the purchase, or some banks allow you to wrap them into your closing costs. Most people, first-time home buyers, get a $500 bill that they have to pay before they get the results. That is normal, especially in this area. You're not allowed to pay for an independent appraisal as part of the lending process. They can't use that information. They have to use a third party or independent company that they hire. You can supply it, but it does not mean they have to look at it. And then if you have a question, you can ask your lender for a second appraiser, which you'll have to pay for, but it could be good information for you. Here's where I got all my information. Anybody have questions?
So I've heard that it's like crazy hard to get appraisals done within 30 days now. Is that same thing happening where you guys are?
Oh yeah, for sure. Appraiser.
Yeah, I had to beg to get an appraiser out within 30 days.
Even in busy areas, Rick, like the Lehigh Valley, you think they'd have no problem coming out. The problem is they're so saturated with purchases, refinances, and from what I'm told from different lenders, they are actually a very unique breed of people with high certification needs to become an appraiser. You need like 1,000 independent appraisers or appraisals to be certified on your own. That's just what I'm told. So there's less and less appraisers for more and more appraisals. And now you put properties that are out of the zone of where people want to work. You know, if you had 10 different deals and you got paid per deal, you pick the ones that are closest and most convenient to you. These little towns outside of the area that they have to travel to, it's a lot of work. And for the same pay, they're kind of financially driven, and I see where they're coming from, but you're right. Haven't had one less than 30 days. In fact, I had one over 50 days. That's crazy. Anybody else have experience with that?
Yeah, so that's going to be another function of what's delaying things. If you're, I mean, because if you're trying to buy a house and you're waiting for the appraisal, that pushes closing out. Like,
yep. And what if the seller of the house you're buying has a house that they're buying or they have to sell? And now it's just this domino effect. It's crazy. Yep.
Well, thanks, Matt. I think I got 1 o'clock as well.
Yep.
Great call.
All right, guys. I will stay in touch. I'll send this out. I really appreciate everybody calling in. I know it's a small group today. All good.
Yep. Thanks for having us.
Later, guys. See you.
Yeah.